For our COBT listeners and viewers, it's Maynard, Mike, and Todd here with a very special guest we've been pursuing for quite a while now, and we finally got the schedule to work. Samantha Dart. She is the head of global natural gas research at Goldman Sachs. She's a longtime friend, and she is an expert in all things global gas. And so that is a big, wide category that it's one of our favorite flavors. And Sam, we're just so delighted to have you. Thank you for joining us today.
Oh, thanks for having me. It's such a pleasure.
Well, we're super excited. We can't wait to jump in. We got lots of questions, lots of things to talk about. Some recent reports you've written. We're really super pumped. Mike, before we jump in with Sam, what would you tell us about the market, the world, the Seminoles? Anything you care to give us an update on?
Well, we'll leave the Seminole update for about 2 or 3 weeks after the first game, and then we'll give you an assessment.
Okay, I didn't know if you had any preseason for
But it's looking good. It's looking good so far. We're 0-0. Anyways, maybe hit on 3 things. Economic standpoint, we'll talk about crude, and we'll sort of set up some natural gas stats for Samantha's talking here in a little bit. Just from the standpoint of economic stats, it's a pretty heavy week, and tomorrow we're going to get the FOMC minutes are going to be released, so people are going to be talking about that. And you're also going to have payroll revisions tomorrow as well. I think expectations look like they're anywhere from 300 to 500,000 adjustment lower, so we'll see how that affects bonds. And on Friday we get the Jackson Hole Economic Symposium. As you recall, we have this every 12 months. That's going to be happening on Friday. So we're going to get a very good feel for where Chairman Powell stands. Most expect him to come off with a dovish tone, which will set up September rate cuts. And so people are watching that from an economic standpoint. From a crude oil standpoint, it's been ugly, right? Crude oil is around it's under $74 a barrel. It looks like there's support around $72 a barrel. And the market's really kind of struggling between 2 things. One, on the bullish side is, sort of, hey, when is Iran going to attack Israel? And the other thing is, this, Ukrainian incursion into Russia. So that's sort of the bullish aspect. The bearish aspect is just global economic growth. I mean, it seems like every day someone else is coming out with just some bad demand statistics on China and what Asia's looking at, and it looks like IEA and OPEC have downgraded growth from Asia and really pretty much China. And so that's kind of a headwind. Until we reverse that, crude oil is just not going to break out of its trading range and maybe even test the lower bands of its trading range in the low 70s. From the standpoint of natural gas, I just want to give a couple statistics before we start to talk to Samantha here. Natural gas prompt today is around $2.20 an M. The strip is around $2.95 to $3 an M. TTF gas in Europe is around $38 a megawatt, or around $13 US equivalent. But that's up from $10 US dollar equivalent probably a month and a half ago. European storage is 90% full versus 82% full on average from a seasonal basis. US gas storage surplus is around 370 BCF, which is, about 12 to 13% above normal. But, when we were coming out of basically, out of the withdrawal season, it was roughly 640 BCF, so 40% above normal. So we've come down there. Lower gas production in the U.S., lower 48 is around 101, 102 BCF. It's kind of been that way for most of the year and for the last 3 months. And the last thing I'd say is just if you listen to Q2 calls, the E&P calls, natural gas calls, it feels like there's a couple BCF of curtailments that are coming. At least people are talking about. We just haven't seen that in the lower 48 stats as of yet. My guess is that's just because of frac efficiency, well efficiencies. But if things continue the way they are and gas stays at these levels and those cuts go through, we're probably going to see some of that hit later this year. So it's probably setting up for a better 2025. And I'd say from a 2025 standpoint, I think there's bullishness, not significant bullishness, but better than it was in 2024. And so on 2025 futures, you have 330 an M is literally is where futures are. But consensus is around 350, forecast around 350, so a little bit more bullish setup for analysts into 2025. So I just want to throw that out there. Samantha's going to talk about sort of her outlook for second half 24 gas, 25 gas. what LNG means, in over the next year, over the next 2, 3, 4, 5 years. So we're really looking forward to talking to her about some of these things, especially on the LNG growth track through the end of the decade. So with that, Maynard, we'll turn it back to you.
Mike, thanks. Todd, I know you had a couple thoughts on your mind before we jump in with Sam.
Yeah, no, I'm looking forward to the discussion as well. This will be a long way to tie back to natural gas, but yesterday, one of our partners sent around a McKenzie report that was 25 physical challenges for the energy transition, which looked interesting. And so, I popped it open and started to read it, and a couple numbers really jumped out to me, which I think maybe illustrate how difficult some of these net zero scenarios are. So at the beginning of this paper, it said that these challenges are based on the McKenzie Achieved Commitment Scenario, which is not a forecast, but it's a scenario. In the scenario, by 2050, we would need something like 1 billion EVs deployed on the roads. We'd need 1.5 billion heat pumps sold and 35 terawatts of low emissions power generation capacity. And, I don't know much about these kind of numbers, but they sounded pretty big to me. So when I went and researched 1 billion EVs by 2050, right now we sell about 75 million new cars globally every year. So, and about 20% of those are EVs. So if we sold immediately 50% of all new cars became EVs for the next 25 years, we still wouldn't get to the billion EVs that they're talking about. Even more striking is that they say we need 35 terawatts of new low emissions power generation capacity. Today, in the whole world, we have about 8.5 terawatts of total power generation capacity. So we would need to increase power capacity 100% clean by 4x to hit these kind of scenarios. I bring all this up to say we're talking about natural gas today, and natural gas is sometimes referred to as a bridge fuel to a clean energy future or whatever. And when you read the stats about what a clean energy future means, sometimes they just seem so unrealistic that I feel like natural gas is a bridge that is probably going to last a pretty long time. So I would encourage anyone, and don't take my word for it, you can go look at the reports, you can do the math, read the scenarios yourselves, but they're pretty hard to achieve without something like natural gas. So with that, Maynard, I'll let you jump into the conversation.
All right. Well, Samantha, we're so happy to have you. I mentioned it up front. I think that's for a lot of reasons. I mean, one, to Todd's point, we've always been super excited about natural gas. We don't see a world where it's not a huge part of solving the world's goals and problems and helping it get all the energy it needs. But also, what a topic. It touches on so many things. Global gas, I didn't do enough of a good job in your intro, Sam, because you were at Goldman Sachs for 8+ years. You're a PhD economist from Chicago, which I know that is like the Hall of Fame for economists. And then you also worked at Mercuria, and so you saw that side of the world before you returned to Goldman again in November 2018. So you're a good friend. It's a great topic. It's a global topic, and it's just right at the heart of the energy world. Let me stop talking and welcome you, and just ask you to share what is getting you excited these days. We know we're going to talk about some of these issues, but what are the main things on your radar as you're doing your work these days?
Yeah, absolutely. And I think for us to talk about U.S. natural gas, as you guys hinted on already, we really have to talk about global gas and how all these pieces fit in together. So I'll give an example. When I look at U.S. gas markets today on the demand side, you will not find a demand driver more powerful than LNG exports. Even including the whole hype about data center and AI and power and all that, the scale of what these new LNG export terminals have and the impact that they can have on the balance tops it all. So when I'm thinking about this market, whether it is today or 10 years from now, the two questions I'm asking myself is again and again, how much production is growing this year versus how much LNG exports are growing. I really think that's the key to how we balance.
And Sam, could I ask you, just because as we go, a lot of these numbers are really helpful. So Mike referenced it. We've got a roughly 100 BCF a day market in the U.S. About 15-ish is the LNG draw of that. Is that roughly the right number?
Yeah, the capacity is a little over 14 right now, but in the summertime, because of maintenance, we tend to operate at slightly lower level than that.
Okay. And then, I got to be careful with using numbers with you guys. It's a very specific group. And then if you think about 2030, not too far from now, 2030, roughly how big do you think the U.S. gas supply demand is? And then roughly how big do you think LNG exports are?
Yeah, I really think we need to start with the demand side, and I'll explain in a second. So I'm
kind of doing like energy flashcards here just to help people following at home, but let's go with it. Okay.
So let's think about the demand side first, and let's start with LNG. Like I said, this, in my view, is the biggest driver here. I think we can add over the next 7 years. So by the end of the decade, we can add easily at least 10 BCF a day of additional exports to the balance here. That's just on the LNG side. On the power side, it'll depend on how total power demand evolves from here. But we think we add probably in those 7 years, I want to say between 5 and 9. I say 5 and 9 because at least 5 from data center demand, but there are other drivers that can contribute from a total power generation demand as well. So let's go with the middle of the road, maybe about 7 BCF a day of power demand for gas. But I really don't think we have an issue with production growth. The question is just how high prices need to go to make sure producers have enough incentive to deliver that required growth. And then you can also ask, well, but where is that gas going to come from? And it's not always from the same place. Today, and for the past few years, Haynesville has been the main source of dry gas growth in the US, and it comes a point where that inventory is exhausted. You can't count on Haynesville forever. And once we get to that point, which we think we get to that point before the end of the decade, then we likely move to the next best thing, which is, whether it's going to be Eastern Texas or Oklahoma, it remains to be seen at a slightly higher cost. So I think the real question is how high prices need to go to make sure producers deliver in a way that is consistent with demand growth.
And I know it's totally unfair, but since we're doing this, fun with the future, roughly what might be a gas price in 2030 if we have 117 of demand and we have 25 of LNG and Haynesville's a little depressed. Like, do you have a rough sense of what a gas price would have to be to make that possible?
Yeah, so when I think about long-term natural gas prices, and I'm thinking exactly of, okay, what is that incentive price to get production to come on? If we ask ourselves today, what is that marginal cost of Haynesville, because we're already dealing with non-core Haynesville today, that's already in a, let's say, $3.75 to $4 range. So we're likely to be above that because we're going to have to keep moving on to the next best thing. I think this moves us to a $4 to $5 range in that long term. But because U.S. gas producers are so good at what they do, I think we're much more likely to be at the lower end of that range than the top end. So when I think of long-term gas prices, I typically think of $4 an MMBTU, and that's the reason.
And do you think, I know we'll get into the LNG expansion, which you've written a fantastic report on, we want to touch on, and that's a global phenomenon. But when you think about the infrastructure in the U.S. needed to handle 117 Bs a day and maybe from some different locations. Do you think most of that infrastructure is there? And so we won't have bottlenecks or lots of expense getting the plumbing right around the 117 Bs? Or what do you think about that?
I think we'll have transient bottlenecks. So today we have a more permanent bottleneck in the Northeast that's much harder to solve. I don't think anyone in the industry thinks that's going to get solved. But when we think about where demand is growing today, especially from LNG, it's more in the Gulf Coast. So if you're thinking about growing pipeline capacity in Louisiana, in Texas, that's where we usually manage to do it. So it's not all there today, but I have all the confidence that that will be able to build out over time.
And can I just ask you while we're on it, in terms of supply, I think what everybody always has this feeling about is all this Permian gas that, periodically, it just unfortunately has very little value because there's so much of it, et cetera. How do you think about the value of Permian gas, between now and 2030 and how it might change?
It's that same dynamic that you described, right? If you're bottlenecked, then you lose value at the local hub. And then once you debottleneck, we're about to see another debottleneck happening in the system towards the end of Q3 this year. Then you get more room for the gas to flow, and then you get prices better supported. I think when it comes to associated gas out of the Permian, it's that back and forth that we have to deal with, because it's just very unlikely that we will match exactly the incremental pipeline capacity needed with the gas production, which, as you said, is driven much more by the oil price than by the gas price. So it's a give and take. It's bottleneck, resolve, bottleneck, resolve. So I don't think we're going to escape that on a permanent basis. I think we'll see this again and again.
Do you think it means, though, and I'm kind of leading the witness because I'm wondering if this might be the case, but do you think it means that in terms of change in relative value, Permian gas might, as we move farther inland in a way to get more gas, it seems like it might be the gas that revalues the most, or maybe that's just not the case. Or do you have a feeling for that?
At times, right? At times. So we're about to add a big pipeline towards the end of this year. Once we do, then yes, the gain in those local prices will be quite significant. I think you're right. But once oil production growth is large enough to then bring another bottleneck to the region, which we think can happen in about a year and a half or so, then we're back to where we started. So is it a permanent gain? Probably not. Probably you go back to those losses before you resolve it again. So I think that's the challenge of the Permian.
And you, just while we're on this, I guess right now the gas that comes as a byproduct of oil drilling, the associated gas, what percent of the gas production is that in the U.S.?
Yeah, we're probably close to 25%. I'd say
about 25%.
25%.
And would you roughly expect it to be the same in 2030 as you model it? Like what gas is coming for what reason? Or how tied do you see oil and gas markets in that way in 2030?
No, I think the share will likely fall. The amount of growth we see in associated gas today is coming much more from the Permian than back in Niobrara. So it's essentially just that region. So you get, let's say, 2 to 2.5 BCF a day at a time. If we're gonna need to grow your total production by almost 20 BCF a day, and you're just getting 2 BCF a day at a time, you're probably going to be a little bit below that share, maybe closer to 20 than 25 by 2030. I don't think we deviate too much, but I don't think we're going to be growing that share. Okay,
so now we've kind of set the table there around some of these moving pieces. Maybe let's get to the big one, which is So you mentioned LNG in the US, not quite 15 now, growing another 10 BCF by 2030. You've written a report on global gas where the US is expanding its LNG capacity, Qatar is expanding its LNG capacity, Europe has started planning more around using natural gas, and you should walk our audience through it, but your punchline is we're going to add a dramatic amount of LNG capacity into the world markets over the next 5 years or so, much more than we did in the previous 5. And that's going to have real effects on gas prices and power prices. And that will also have a lot of implications for the location of industry and all kinds of things. So now let's go to the big one, which I think that's the big one. You've got other things to talk about too, but walk us through that thesis.
I think you're right. When we think about the biggest repricing ahead of us, it's outside of the U.S., not in the U.S. in the sense that we talk about all this growth of LNG export capacity in the U.S., but as you pointed out, so many other regions are doing the same, in particular Qatar. And the scale of that supply capacity addition is much larger than what the rest of the world can absorb quickly. And this is what ends up causing a situation where, in the same way that in the US, when we are oversupplied, prices have to move lower to look for that incremental demand, and sometimes even incentivize production shut-ins, as we saw this year. The rest of the world is likely to go through a very similar process. So we're adding all this LNG supply. Asia can't possibly absorb it all in one go. And the likelihood that prices go down significantly is extremely high in our view, because you're going to have to look for that incremental demand. And this matters for US markets, because if you get to a point where global gas prices are dropping, because the market is looking for that demand, but they drop to a point where you've exhausted that demand sensitivity and you're still oversupplied, the only way out of that situation is global gas prices dropping enough to shut in supply. We've seen this play out before in 2020 when the pandemic was raging. We were in a similar situation in that case because demand disappeared, right? It wasn't necessarily just a supply issue, it was a demand issue. But the outcome is the same. We were pushing against storage capacity, global gas prices collapsed, and the outcome was that US LNG moved out of the money to flow. So all this LNG that we export today, that represents demand of US gas today, may decline significantly at times when the rest of the world is oversupplied over the next 5 years. It doesn't mean it'll necessarily happen. You may have a cold winter that creates room to absorb a lot of that LNG. But if you happen to have a warm winter, if you're looking at a summer, let's say whether it's summer 26 or 27, when the Qatari expansion is really coming online in full force, it's likely that you're going to be oversupplied, and that's a real risk for US gas markets.
Just help us a little bit with the current scale of the LNG market and the potential range of increase in supply as you see it between now and 2030. Like just help us get the proportions there.
Yeah, absolutely. So between now and the next 5 years, globally, we're adding a little over 200 million tons of LNG export capacity in a market that sold a little over 400 million tons over the past year. So it's equivalent to about 50% of this market. But I think the most important stat is not even that. It's the fact that when we look at how much demand growth happens in Asia every year, on average, and let's remove the COVID year, let's remove the China lockdown year of 22. On average, Asia LNG demand growth annually is of about 18 million tons a year. So you're adding 200, and they can only absorb 18 per year. So it doesn't add up. It doesn't mean we're going to be oversupplied forever, but it tells you that we're going to need time for Asia to absorb all that glut, and we're likely to need lower prices as well to get it done.
Samantha, so if I'm thinking about the Goldman thesis and I'm sort of wanting to get into LNG at this point in time, if you don't have basically permits, if you haven't FID'd, if you don't have funding and you don't have long-term contracts, you'd be foolish to be chasing LNG at this point in time. Is that a true or false statement? Is that kind of fit into what you're thinking?
Yes, I think that's absolutely correct.
Okay. I guess the second thing from going and reading your report is that one of the things that we're counting on for power demand growth over the next 4 or 5 years in the U.S. is sort of reshoring of industry to the U.S., deindustrialization of Europe. And your piece talks about the amount of savings from an energy standpoint with LNG going there is going to be something like $2 trillion a year. And it sounds to me that there could be risks that reshoring to the U.S. that we expect because of energy prices in the next 3, 4, 5 years, that's going to work in Europe's favor. Is that a true statement? And just talk about how you think that plays out, because it seems counterintuitive to consensus out there.
Yeah, so Europe has been going through a really tough time from an industrial perspective since they went through the energy crisis in 22. I mean, their energy prices were already higher than US energy costs to begin with. What 22 did was exacerbate that difference by a lot. So when you think about the market share of those manufacturers in Europe, that's gone down significantly. When you think about utilization rate of existing industrial capacity in Europe, it's gone down significantly. Just to give you a sense, we have daily data on industrial demand for natural gas across Northwest Europe. And last year, that averaged about 26% below the pre-crisis average. And if you look at gas prices in Europe today, they are already much lower than they were during the crisis. During the crisis, they went above 300 euros a megawatt hour, were between 30 and 40 euros a megawatt hour today. So prices are a lot lower, but European industrial activity remains under severe pressure. So we've been going through this deindustrialization process of Europe. When you talk to industrials, when you talk to users of gas and power over there, as we do on a regular basis, what they say is, well, even if I'm not actively shutting down my existing capacity here, I'm going to at least look into my growth capital being reallocated elsewhere. And that elsewhere is oftentimes the US. So we do expect industrial activity in the US to pick up in the coming years. A reshoring, as you put it, of industrial activity, because the US energy is so much cheaper than in Europe. But because of this oversupply of LNG that we're talking about over the next several years, we think that plays out mainly from 2026 and for most of that second half of the decade. This high energy cost that has been such a big issue for Europe is going to become less of an issue. They are going to have access to cheaper energy. So we think that this process might help at least halt this deindustrialization process in Europe. Maybe it can help them recover a little bit. But to be very clear, we don't think industrial demand for gas in Europe will ever go back to what it was pre-energy crisis.
And that, just so we're all clear, when you talk about the energy crisis in Europe, you're still referring to the period pre-Putin's invasion of Ukraine?
I'm referring to 22, and the Ukraine war started in that February. But if you look at the Russian sales of gas to Northwest Europe, they started to get cut before that. You're right. So as of September 21, that's when Russia started curtailing the sales of spot gas to Northwest Europe. From that point on, supply availability in Europe just went down and down and down and down. And that's when prices had to discover how expensive does gas need to be to shut down industry. And they found it out.
Well, I only raise it because, it sometimes the lines get blurred and people forget about Europe's energy problems pre the invasion of Ukraine. And I just wanted to make sure that's what we were visiting about. But Todd, let me get you to jump in here.
Yeah, thanks, man. Super interesting, Samantha. On your long-term LNG, or let's call it global gas pricing forecast, where we're going to drive prices to sort of, not shut in, let's call it non-export economics. When you do that, what happens to, demand for other commodities? So, natural gas is not moving in a vacuum. You've got crude moving around, you've got coal moving around, and while I appreciate that we've only grown the demand side of the LNG market by, the 18 million tons a year, if you drive gas down that low, it feels like you're creating an incentive for lots of new pockets of demand. Now, I completely recognize that the LNG overhang is massive and will take a long time, but I'm curious, how does that price forecast align with, what the house view might be on where crude is going to be or where coal is going to be? Because I think that price is pretty low relative to crude historically, especially for consumers of LNG. But why don't you talk about that for a minute?
Yeah, that's a key point that you just raised, because when we think about what happened in the US, maybe the US is really the best example to illustrate what can happen in Asia from here. Shale gas came about in the middle of 2008. That's when, if you remember, the storage injection stats started to go crazy. And from that point, gas prices started to drop, and they dropped, as you mentioned, they dropped relative to oil and relative to coal. And it was that drop in the relative price that really was what sorted out that oversupply of gas that we went through. More often than not, when we look at the past 15 years, we balance the US gas market by pricing low enough relative to coal to generate enough coal to gas substitution and manage storage that way. So I think you're absolutely right. If we have this glut in the rest of the world and we have gas prices under pressure, the same thing is expected to happen. We're going to see natural gas cheaper even relative to oil. It already is cheaper, but the cheaper it gets at the margin, the stronger the incentive for that household that never switched heating from oil to gas to finally do it. That industrial user to switch from oil to gas, and so on and so forth. Power generators. And in particular in coal. If we think about where coal is consumed today, about 80% of it is in Asia. So the potential for that substitution is enormous. Now, the caveats here are that if you look at countries like China and India, which, by the way, by themselves, they concentrate between 65 and 70% of coal consumption globally. Those two countries have vowed to essentially continue to rely on coal for power generation until they can use renewables, right? So we haven't really seen natural gas take much space in the generation sector in China and India in particular. But in the rest of Asia, that's happening more visibly. If you look at South Korea, for example, it's been a few years now, maybe 5 or 6 years since they started to deliberately shut down their coal capacity, not permanently, but they would shut it down to a very low utilization rate in the peak of winter, in the peak of summer. And as a result, natural gas usage was increasing slowly. It just didn't increase enough because they were also growing nuclear generation. So it offsets it a little bit. But you started to see some coal to gas substitution elsewhere. In China, to be fair, we did see a lot of coal to gas substitution, but it wasn't in generation. It was in industrial use and it was in heating for homes. So when we look at the next 10, 20, 30 years, the potential for a fuel substitution is enormous in the region. I think you're absolutely right. But as you pointed out, it takes lower gas prices to really put that incentive there in everybody's face and say, listen, just go and do it. And in the US, this played out really nicely. I think the incentives are going to be strong enough to help create more structural demand in Asia as well. So I really don't think that oversupply that we're talking about in global gas is going to last forever. I think it's temporary. It's going to last a few years, but it's those few years that will create the foundations of much stronger gas demand, a lot of it via fuel substitution as what you're talking about.
Sam, do you think that, I was thinking about the 10 BCF that you were talking about being added to U.S. LNG export capacity. There's additional capacity coming in Qatar, other places as well. Is it fair to say that at least the U.S. projects, you can talk about all of them if you like, but most of that is contracted, right? So yes, if they are building those facilities, they have an offtake at a price that justifies those facilities. So does that mean then that this gas market you're talking about, this global gas market, there are some people who've already spoken for a lot of supply, and it's at what you might call good prices from the LNG exporters' standpoint. And then there's going to be this spot market stuff or the non-contracted stuff that really gets depressed. Like describe for us the market, because it is, so much of it is already pre-sold, or you wouldn't have built the facility.
It is pre-sold, but the contract still allows the buyers to not take it. The clauses usually are that the buyers have to pay what they call a liquefaction fee. It's a fee that typically covers the rate of return of the liquefaction facility. So if I'm building a liquefaction facility in the US and I'm contracting my capacity, I want to make sure I get paid for building that facility no matter what happens. So this is the case for all these facilities that are being built in the US and that have been built, all the existing capacity as well. All of them have contracts with off-takers that have agreed to pay that liquefaction fee no matter what. But that consumer of the LNG still has the choice not to flow the LNG. They still have the choice to turn to that facility and say, actually, I'm not going to buy the gas. I'm still going to pay you for the liquefaction fee. Usually that's about, it varies, but let's call it between $2.50 and $3 an mmbtu. I'm still going to pay you for that. But when I'm buying LNG from the US, what I'm really thinking about when I make that decision to buy or not to buy, even though I already contracted, so that $3 I'm paying every month no matter what. So that drops out of my equation. What is still at play here? Well, if I buy the LNG on top of the liquefaction fee we talked about, I have to buy the actual gas. I have to pay, usually it's about 115% of Henry Hub. So that becomes my variable cost. That plus whatever variable cost I have to move the LNG around. Mm-hmm. So ultimately, as a buyer of US LNG, the prices I'm comparing are the 115% of Henry Hub plus transportation to whatever LNG is priced in the spot market. So if LNG in the spot market happens to be cheaper than 115% of Henry Hub, guess what? I'm just going to choose not to buy the US LNG I contracted for. It's just cheaper for me to buy spot than to buy Henry Hub based.
And those spot cargoes, are those coming out of Qatar, or where will those spot cargoes come from?
Several suppliers sell spot. So that's the beauty of this market is when you look at TTF, the benchmark for natural gas in Europe, it's a liquid enough benchmark that can give you a very good idea of what a spot LNG cargo is selling for in Northwest Europe. When you look at the JKM price, the Japan Korea marker published by S&P Platts, that's a very good proxy for what a spot LNG cargo is going for in Asia. So these markets today, they have enough liquidity that I'm able to compare those volumes, and then the seller can be whoever. It could be an Algerian cargo that doesn't have a home, could be a Nigerian cargo, could be a Qatari cargo, you name it.
And then kind of roughly today and maybe roughly in 2030, if you don't mind, what percent of the market is spot versus not now, and how do you see that changing?
That's really hard to say. I mean, I'd say today consensus is that spot market is probably close to 30% of this market. But honestly, I think the split between spot and contracted is a lot less important than people think. First, because the spot component alone is large enough that it can help rebalance the regions when that's necessary. But second, if we think about what happened in 22, when European prices were through the roof and China was under lockdown, so they had no demand for the gas, China got a lot of pre-contracted cargoes and they sold them in the spot market. So does it really matter if it's contracted or not, if you can resell it? I don't think so.
So does this feature you're talking about, which is, yes, I contracted for it, but I can just choose to pay you the liquefaction fee and not buy the gas and not pay the transportation, so I can basically not take delivery. That mechanism, does that really, it's going to kind of help keep things in much more balance than you might otherwise first think? Because at first when you start going, oh my gosh, we're going to add all this capacity, and then all this supply is coming, and it'll be so rough on gas prices if you're a producer, so great if you're a buyer. But that mechanism you're talking about looks like it might just leave a lot of the gas in the ground. And so therefore, like what does that really mean for prices both in the US and in Europe in particular?
It means that when the rest of the world is overwhelmed with gas, which is, to be clear, not our base case for this year, not our base case for next year, but a growing risk between 26 and 28, we think. When that happens, the risk is that your global gas prices might move low enough to force that US LNG to stay on the ground, as you put it, which means the US market would then have to deal with an oversupply itself. We just had to deal with a big oversupply this year. We had prices below $2 an MMBTU between February and April this year. That gives you a glimpse of what we might see again.
So if I'm in Europe, if I'm an industrial player in Europe right now, and you have a really neat chart in your one of your materials, you talk about the number of times the word deindustrialization comes up in European articles, news, etc. But if I'm a European industrial player, I've started suffering in 22, maybe late 21, as you mentioned. Things, I'm looking at it now. I might have some help coming on the way, 25, 26. How, if you're a European industrial planner, do you think you can get comfortable with pretty good energy costs out through 2030 because of this? And therefore, what do you think about European industrial demand by 2030 and just otherwise European economic activity as a result? How comfortable should I be if I'm a European industrial player, I guess is the question.
Yeah, I do think the outlook is positive, but with limits, meaning we mentioned earlier that industrial demand for gas in Europe was about 26% below the pre-crisis average last year. Mm-hmm. I think they can recover to, let's say, between 10 and 15% below pre-crisis average. So it is positive from here. but nobody's comfortable, nobody's happy, nobody's confident, to be honest. In our conversations, everybody's just trying to survive. One of the other factors that have weighed on their sales is also some manufacturing growth in China. That China is exporting a lot more automotives today than it did before, and this is weighing on European manufacturing of cars. This is just an example, but petrochemicals are the same. So when we look at what demand picture these guys are looking at, it hasn't been great. So first they had that shock of high energy costs they had to deal with, but today it's really a demand picture that is so weak at the moment still.
We always wonder about that Russian gas and all that supply, and if you did get a peace in Ukraine, if the war ended, and people 2-3 years from now, like, do you have as a wild card in your mind Russian gas returning to Europe?
So let me put it this way. I think it can. And when we talk to German industrial users of gas and power, they say they would buy it. But I think it's much more complicated than that. Let's start with the pipeline capacity. The largest pipelines that used to take Russian gas to Germany, they've blown up. They're not there anymore. So today we would have to count on a pipeline via Poland and the pipelines via the Ukraine, which means that as a first step, before this thing can happen, we need not just a deal between Ukraine and Russia. We also need Poland to be happy with the whole situation. Let's say this all happens. Let's say it's all resolved. I think the next thing that makes it complicated is the fact that if Russia starts selling gas again to Europe on a spot basis, this is a much bigger benefit to Europe than it is to Russia. To Europe, it's going to keep the market completely oversupplied. It's going to keep energy costs, not just gas, but electricity, remember, very, very low. So it's great to incentivize economic growth, right? Great benefit to Europe. What is it to Russia? A little bit more revenue with gas prices super depressed? Because if we go back to before the war, before the Ukraine war started, and you look at the trade surplus in Russia as a percentage of GDP, gas revenue was about a little over 3 percentage points of that. The trade surplus was about 15%. Gas was 3 percentage points of that. Oil was more than 10. Russia definitely wants that oil revenue, but gas was a little over 3. Could they live with a trade surplus that looked like 12% of GDP instead of 15 long term? Yeah, they could. What I'm saying is the gas revenue is not as important for Russia as some people think. So I don't think this would be balanced. I think selling more gas to Europe on a spot basis would benefit Europe much more than it would benefit Russia. So would they do it? Not obvious to me that they would in size. It'll probably flow at some point, at some volume, but I would not expect those volumes to be nearly as large as they once were.
Samantha, what's really interesting to me is listening to first quarter and second quarter earnings specifically from midstream companies, from E&P companies, et cetera, and their projections of what gas demand is going to look like from power, just this AI build out, stuff of that nature. And you guys, I believe, are around 3 to 4 BCF per day by 2030 is what you're projecting. That seems... and like I said, there's a lot of numbers being thrown out. I don't know what's behind those numbers. So I really want to ask you, what is behind the 3 to 4 BCF? What is that predicated on? Where could it be right? Where could it be wrong? Stuff of that nature. What are your thoughts there?
Yeah, that figure, a little over 3 BCF a day, that refers just to the data center component of power demand growth. And that assumes that the data center demand for power is not going to rely solely on gas. It's going to go about 60% to gas, 40% to other sources of power. But if you assign all of the expected data center power demand to gas, that figure changes from a little over 3 BCF a day to a little over 5 BCF a day. But let's not even stop there. Let's say not just total data center demand, but the whole power demand grows as our equity research team expects. So the data center component is about 29, 30 gigs between now and the end of the decade. But total power demand in the US, they expect to reach close to 90, a little over 90 gigawatts. Let's say that happens. Then based on how they expect the stack to move, so the amount of gas capacity to grow, the amount of renewable capacity to grow, that number would imply about 9 BCF a day of incremental gas demand between now and the end of the decade. But if we break that down by year, and they expect it to be a somewhat stable growth, that's about 1.25 BCF a day of gas demand growth per year. When over the past 10 years, our average production growth is closer to 4 BCF a day. That's why I struggle to be bullish natural gas just on the power story, because even with a very positive outlook on total power demand, 9 BCF a day's worth, I can easily meet that annual growth with annual growth in production.
I'll jump in with one more here real quick, Samantha. We've been talking about a lot of bearish scenarios for natural gas, and I think that's realistic. On the bullish side, to the extent things get cold, to the extent production disappoints, what sets the price on the upside? We have retired so many coal plants. We have lost the ability to switch between natural gas and resid, natural gas and heating oil. Like, if things get tight, where are the natural sort of supply demand substitutes for natural gas, for Henry Hub natural gas now?
Yeah, so when we look at the past, let's say 15 years or so, the times when it got tight were the times when gas prices sort of left PRB coal prices behind, then they ran towards Appalachia coal prices. Appalachia coal prices, they move with international markets. So if you remember in 2022, when Henry Hub was reaching $7, $8, $9, $10 an MMBTU, I think one big component of those high levels was the fact that coal was pricing at record high levels internationally, so that Appalachia coal was through the roof. But when we look at gas relative to coal, gas wasn't at $7, $8, $9, $10. Gas wasn't even matching coal prices in gas equivalent terms at that point. So I really still look at Appalachia coal as a benchmark. Let's call it a first benchmark as to where gas would head if we faced a tight situation. Now, international coal prices are a lot lower, so that range for coal substitution is, I would say today, between $4 and $6 an MMBTU. So that's the type of rally. But you touched on a very important point. Coal capacity has been shutting down significantly over the past several years. So the amount of Appalachia coal to gas substitution we could see being reversed, right? If gas becomes more expensive than Appalachia coal, you get out of gas and get more into Appalachia coal burn. That's going to be limited. I don't expect that to be bigger than a BCF a day. So if you have a sustained tightness bigger than a BCF a day, then you need to look for the next best thing to offset against. Sometimes in the winter, we see local pricing doing that against oil, right? So we can price against oil. That's one possibility. But if we had a true tightness, one thing that people say is, oh, Henry Hub would just rally to shut that LNG export arb to keep the LNG in the US. The problem with that argument is that when the US gas price rallies to shut the arb, if the rest of the world still needs that LNG, global prices will rally right back, and so that you keep the arb open until somebody gives it up. What is that price at which somebody gives it up? we've seen anecdotally that industrial demand for gas in China has given it up at about $17 an MMBTU. We saw that in Europe during the energy crisis, we needed to go to $25 an MMBTU on a sustainable basis to shut down industrial demand. So it gives you a sense of the range we could get with a sustained tightness. I think this is a key word here, because if we have a cold shot, we rally a little bit, we get 3 BCF a day from Canada, done. Or we rally a little bit, we get weekend flows from the LNG facilities that they have storage there. So they just sell it back to the grid, done. So temporary tightness doesn't require that type of rally that I'm talking about. Temporary tightness can be solved with Canada, can be solved without LNG. What I'm talking about here is if we had a sustained tightness and production just couldn't come on quick enough, those are the types of price levels that would be required to cause a sustained shutdown of industrial demand.
Sam, we knew this whole thing would be fantastic, and you did not disappoint. You're killing it. What do you think? I mean, one of the big picture things that we talk about here in a energy policy context is just natural gas, its usefulness, its acceptance. Some people label it fossil fuel. You know, it has this on again, off again feel to it in terms of its acceptance. Where do you think the world is in terms of embracing natural gas as a permanent answer or a multi-decade bridge or whatever the language is? Where do you think we are in the debate around natural gas?
You know, when we use gas for power generation, we emit less than half of the carbon we emit by burning coal. So I think the advantages in reducing carbon emissions by using more gas in generation versus coal, I think that's very clear. But when we think about gas usage elsewhere in the world, at times there are other factors that come first, like affordability, like energy security. Again, I'll bring the China example. China has very large power demand and growing. But if you ask the SOEs, what fuel do they expect to rely on to generate that power and its growth? It's not gas. It's coal for now and more renewables. They are growing coal generation and renewable generation. They also have some gas, but gas is in the single digits in terms of share of total power generation in China. Single digits. And the reason is coal is something they can produce. Gas, they are net short of. They produce a little bit, but on net, they have to import it. So energy security is such an important factor in China that I do not expect them to switch to gas in generation in a very significant way. You can still have a lot of gas demand growth in China, even in power, but not because the slice of the pie is bigger for gas. It's the same size of the slice. It's just that the pie is getting bigger and bigger and bigger. Yeah. So it's going to grow, don't get me wrong, but they take energy security very seriously. And that is a massive market that gas is not going to perfectly tap into for energy security reasons. And in the rest of the region, I think affordability plays a big role as well. That's why having cheap gas in the horizon, not for 1 year, but we think 2, 3, 4, potentially 5 years, can be really important in making gas a stronger part of the infrastructure growth in these countries. So there is potential there. I think the world will take up to gas more, but you need that affordability issue resolved.
And totally unfair question. We usually ask the 10-year question, Sam, but since you've been talking a lot about 2030, which is 6 years away, let's go out into like the mid 2030s for a minute. And just when you think about the LNG trade, you know, that far out, do you think we're just going to, you know, keep growing and growing and growing and we just get a bigger and bigger LNG world? Or do we start finding more, back to your energy security comment, more regional sources of gas so that people don't have to transport it as much and they just use it domestically? Like, how do you think about the global gas markets, pretty far out on the horizon? Are they just bigger versions of what they are today, or is there a chance something really changes?
So two things I would say. The first one is that pace of growth of the size of the market is not stable, right? We're about to see a huge jump in capacity. I expect that to be followed by a huge slowdown in capacity growth because prices will be so low. I mean, we were talking about this earlier. Prices will be so low that they will likely disincentivize growing investment in the sector. So yes, it'll grow, but I think it'll slow down a lot. That's one. But also, I think the second very important thing here, I think more likely than finding other pockets of gas that'll be cheaper, is maybe finally getting technology to a point where storage at the power plant level becomes viable. At the moment, we're really just talking about 1-hour batteries to 4-hour batteries. I mean, you talk to utilities, that's what they tell you. So that's not big enough. That's not enough to really push gas out of the stack, the power stack, in my view. So can we get to a point where storage technology really changes the game here so that gas demand can start to move lower? Unless that happens, I agree with what was said earlier. I think gas is a very important bridge fuel here. We're looking at intermittent fuels. How does that even work if you don't have storage? You need to have something you can rely on, and that preferably is much cheaper than the alternative, and gas fits the bill.
Well, Sam, we can't thank you enough. This is awesome. You and Neil and the whole team at Goldman, everybody, you're great friends and you do great work, and we really appreciate the friendship. Any favor we can do for you, we want to do it. And, please come see us in Houston.
It's absolutely my pleasure. Thank you so much for having me.
Oh, we were thrilled. Thanks, everybody.